They were still kind of memorable, like, oh, I was treated special. I got to go, another.
I've been told by the program boss, thank you, Nami, for setting this up and all of the programming here at the library, that we could get ready and start, which is what we're actually talking about, starting your own business. I'm Carrie Campbell. I'm an attorney here in Wimberley. I've been practicing in Wimberley since 1997 and been licensed to practice law since 1995. A lot of this time I've done business formation and consultation. A lot of the businesses I've helped form over the years do have an open file in my office where I do help them maintain their records as well as answer any questions or do contract review and stuff for them over the time. So this is right up my alley. And so I really know it's a big chunk of information in order to try to digest. And so I've broken it down into 6 topics that I thought were the most relevant for those who are interested in starting your own enterprise. This first one is just a very broad overview of what are the options as far as what are the actual entities that you can consider using the Business and Organizations Code, and what might be the elements that you look at and consider in deciding which one is the right fit for you and what your enterprise is going to be. But to just let you know, each month on the 4th Tuesday of each month at the same time, we will then have 5 more lectures that are getting more in depth. Next month, we'll be looking at sole proprietorships and partnerships. One after that, we'll look at LLCs and corporations. We'll then look at nonprofits and other types of organizational structures for those who are interested in pursuing that type of work. And then we'll do lecture 5 will be employees versus subcontractors and how you're dealing with those sort of labor decisions and employee contracts kind of thing. And then finally, what's going to happen if it doesn't work out? How to avoid the pitfalls that will oftentimes not just get you into either financial or legal trouble, but also can significantly undermine relationships, both within families and friends. And I've seen too many of those to know that isn't a serious thing to consider as well. So starting on today's topic, what are the options for business structure in the state of Texas? So first of all, the governing body of law in Texas is primarily found in the Business and Organizations Code. That is a book of statutes that lays out all the various requirements. And then in addition to that, we have a whole bunch of what is common law, which is law that's been created by the interpretation of those statutes by the courts, and they can go in and they'll look at and tell us more in detail how the law is to be applied in different situations. So today am primarily addressing just the Business and Organizations Code and what those options are. I might reference some of those other resources as we get into more depth in later lectures. The very first thing that is an option is the simplest in many ways, and that is a sole proprietorship. Sole proprietorship is literally just you as an individual doing business in a business name. The way it's set up is completely up to you. What the rules are up to you. And so it's typically an individual. It can't be more than one. And you manage everything as if it were your own. Now we'll talk next week when I said we cover sole proprietorships and partnerships. We talk more about how to do that correctly so that you don't get in trouble. But there's not a rule book really to go by when you do a sole proprietorship. If you're using a business name, like Carrie Campbell doing business as Hays County Lawyer at all, I have to register that. I have to go and let people who are the public or who are interacting with me know who's behind the name. And so I have to register that name in any county in which I do work. So, sole proprietorship. Next are various types of partnerships that are available. There is a general partner, there are limited partnerships, and then there are limited liability partnerships. General partnerships are the sole proprietorship form of a partnership. It's basically two or more people who agree to share the income, to share the losses, and to share the management of the business. Whatever they agree to and how they agree to it is up to them. And that's pretty straightforward. And they're able to adjust and to go with the flow as circumstances come up and address whatever issues, financial or human resources or whatever it may be. Very little formality, although that's something, again, we will talk about next week on how do you stay out of trouble when that happens. Because when you don't have as detailed a rule book, it's easy to sometimes get lost and not know what your boundaries are. The next two partnerships have more structure. So a limited partnership is where you have one general partner and you can have one or more limited partners. A general partner is a person who has management responsibilities over the business. They do not necessarily have income or loss sharing. The limited partners have the investment, but they want limited role other than that. They don't want to have a say necessarily in how the business is done on a day-to-day basis. And because of that, they are really only exposed to what their investment is. So their liability is limited. If I invest $10,000 in someone else's business and decide I want to do it as a limited partner, and they get into trouble and run up a bill, I'm never liable for more than my $10,000 investment. If, however, I go and start telling people how to run their business, I'm no longer a limited partner. I've now stuck my nose into the management part, and I can be considered a general partner. We'll talk more about that next week. The final partnership style is the limited liability partnership. Those are for professionals. Those are people who have a profession that's recognized by the state and where you have to have a license basically to do it. So attorneys and doctors, but it can be accountants, anybody that holds a professional license in the state. And they, again, it's two or more, and they will share profits, losses, management. But there is a little bit of liability protection, and but it costs you. And we'll talk more about that too. So after that, we have partnerships, then you have corporations. Corporations are a lot more formal. They are involved in creating these layers of management and the layers of people who own the business as opposed to people who run the business. And corporations have shareholders, they have a board of directors, and they have officers. And then they can have employees and anything else, that assist. It's the one that everybody's most frequently aware of. When you think of something, you think of a corporation, because that's what Exxon is. That's the stuff that's listed on the stock exchange. That's what you would find in your grandmother's safety deposit box. Are these old certificates, right, of stock. And for a long time, that was the only thing that we had as far as corporations. Again, very formal, meaning that they have these different structural levels, and you have to have meetings and everything has to be documented. And we will discuss that later in number 3 in the series, what those formalities are. But those formalities are there to protect basically the shareholders. They're there to make sure that the money is being invested and is accountable, and to make sure that the purposes of the corporation are being met without risking, fraud and other things. The problem that often occurred was, for many years, your choices were a partnership, sole proprietorship, or corporation. And corporations, as recognized under the federal tax law, were taxed. So if a business, a corporation, had $100,000 in income for that year, the corporation paid an income tax on that. And then whatever was profit was passed on to the shareholders, and then they paid personal income tax on those dividends. That's still the way it is. But that doesn't always work for people. So the IRS, decades ago now, created what is called a subchapter S under the big C corporation. And it's known as kind of like as your family held business or a closely held corporation. And this has the same levels of bureaucracy. You have your shareholders and your directors and your officers. You still have your meetings, but it has passed through taxation so that it has this favored tax. And so for a long time, any small business, people who are seeking to do something in their community, something to earn a little extra money, or maybe support themselves and just their family, they had only that C corporation. Well, now they have this ability to not have those same dollars taxed twice. They can actually now use that money for their families. Then Texas and many other states adopted a hybrid, and that's called a limited liability company. And it's an LLC for short. And so a lot of people start hearing more about LLC now. When it first started out, people were wary of it because they didn't know what it was. It is a very good mixture of the benefits of both sides. The thing you have to remember is it's just semantics in some ways. Unlike corporations, where they have shareholders, directors, and then officers, LLCs have members and managers. Members are people who own an interest in the company. Managers are people who run the company. And they don't have to be the same. And it has the flexibility of like a partnership and figuring out whatever that might be. They do have meeting requirements, and but they're limited to like just once a year. You can have more, but that's the base minimum. And the LLC can choose when it asks for its tax identification number from the IRS. It can say, tax me as a partnership, tax me as a sole proprietorship, tax me as an S corporation. So that is very attractive to a lot of people. And it's probably the most commonly used business entity for those who are wanting some tax and liability protections. So then that leads us to the question of, well, which one do I pick? Mm-hmm. How do I judge these things? There's basically 6 things that when I am consulting with a client about what it is that you want to do, that we have to look at. And every case is different. Every client, every story is different in how they answer these different questions. So there is no blanket answer. You can't look at it and say, you should do this or that. You have to look at it and weigh it. And there are ways to do that. The 6 elements are, what are the startup costs? What's the management going to be like? What liability protection am I going to be afforded by this? What sort of tax benefits might there be? How do I change it if I don't like it? Or if there's something that comes along that's more attractive, or I want to sell it? And then finally, what do I do if it doesn't work out? So those 6 things and how they're weighed, like I said, is very particular to any situation. And I'll use a couple of different examples. So let's start out in describing sort of each of those elements and how they apply to these different entities. With regards to like startup cost, there's really no startup cost for sole proprietorships. You know, it's whatever it is, you go open your bank account and order new checks. So you don't have any of that momentum that you have to worry about, you know, this initial structural creation. With general partnerships, that's the same thing. You don't have to register it with the Secretary of State, just like the sole proprietorships. There's no need to do that. When it comes to, when it comes to the partnerships that have some limit on liability, you have to pay for those. So on the, for instance, the limited limited partnerships, where you have the general partner and then the limited investing partners, that is $750 filing fee with the Secretary of State. That is a formal document that you have to prepare and you have to submit. And then you have to renew that every 4 years. And I think it's just like a $50 fee, but you have to renew that every 4 years. When you do the professional limited liability partnership, everyone has to be a professional, if you recall. You have that upfront filing fee, but then you have to renew it every year at $200 per partner every year. So if you've got 3 partners in your profession, you're going to be paying a renewal of $600 every year. Plus, you do have to demonstrate that you have some minimum liability insurance. You either have an account that's set aside, or you have to prove that you have insurance that's set aside for a minimum of $100,000. So that's the startup cost for those partnerships. LLCs, S Corps, and C Corps. They have a filing fee as well with the Secretary of State. Those are $300, plus they now have a convenience fee because everything has to be done online, and it's like basically a credit card thing. And what you file is a certificate of formation. The certificate of formation will say, I want to be an LLC or an S Corp or a C Corp. And that's just the beginning. To get those LLCs and those corporations set up properly, you also have to adopt what used to be known as bylaws. It's now the company agreement if you're with the LLC. And so you have sort of this upfront expense of getting things done correctly. Because of these formalities, you need to make sure that the rule book is established, that rule book is consistent with the organization's code, and that you know what you have to do to maintain that. Which then gets us to the second part, or the second criteria when we're looking at weighing First was the startup cost, right? The second is, how's this going to be managed? How easy, how much time do I have to actually devote to this in order to just maintain the administration part? That isn't dealing with your clients yet or the marketing yet. So general partnerships, sole proprietorships, pretty self-explanatory. If you do it right with partnerships, you always have a partnership agreement. But when you come to these other entities, you do have the structure, and you do have to have some meetings, and you do have a lot of those decisions made up front, so that when everybody puts their money in and signs on the bottom line, everybody knows what's expected of them, what their duties are, what they expect to get in return, the benefits of that. Do I have to invest more money? Can my other, people say, hey, look, we need to invest X number of dollars again. All of that is set up front. And there has to be organizational meetings that assist you with adopting those bylaws or company agreement, and that allow you to get a handle on the formalities. And if you don't do that, there's trouble. For instance, there are a lot of people who on their own go and look up a certificate of formation on the Secretary of State's website, who go in and pay the $300 filing fee and never do anything else. They get a nice little certificate from the Secretary of State saying, hey, we got it, your name is registered. That is only step one in like a 10-step process of meeting those initial formalities. And I'll talk again, like I said, in future lectures about what are all those formalities. But with that, if you don't intend to follow through, you're not going to get the benefits of what you're doing. Because I was mentioning this common law in the courts, you can meet that exact criteria of that form that you filed with the Secretary of State. But if what you're doing doesn't look like an independent business, if all you're doing is just running a sole proprietorship with the name registered with the Secretary of State, they're going to treat it like a sole proprietorship. If it walks like a duck, quacks like a duck, they're going to treat it like a duck. And so you spent that $300 and went through that initial time investment in order to file that recognition with the state because you wanted to have some sort of benefit, either liability or tax-wise, right? You're not going to have it. And don't be deceived into thinking that you have it and make decisions based on that unless you know and actually follow a course of action to meet the different formalities of the entity that you have created with the Secretary of State. On the far left, far right, sorry, we've got the C corporations that have the most formalities. S corps have slightly fewer, but really in a lot of ways as far as management goes are very similar. The LLC is the one that's the hybrid. You only have to have one meeting a year for. It's important who has that meeting, who signs off on all of these things. But at least when you're dealing with bureaucracy, after you get over that initial formation phase, it's fairly predictable and easy to maintain. All right, so then we move on to the next criteria that you look at and consider, and that's liability. Liability with sole proprietorships and general partnerships is wide open. Because you're running this business basically as an extension of yourself, then your liability is yourself. It is everything that you own. It is, there's no boundaries or protections that will allow you to claim an exemption from any liability. So If you have a lot of personal assets or properties or things that you are concerned about and don't really want to risk, then that's the reason people go through the hassle and the expense of these more formal entities. That's the trade-off. The more formal, the more liability protection. So general and sole proprietorships, general partnerships, sole proprietorships have nominal protection. The liability partnership, limited liability partnerships, the limited partner, remember, have some, their exposure is just limited to what their investment is. With the professionals, the limited liability partnerships, the LLPs, those can limit liability based on what you're working on. For instance, if you're in a big law firm and you're handling a client's case on a different floor, and I never see it or know anything about it, I can't be held liable for that. But if I'm the one that's handling that file, my exposure is the same as if it were a sole proprietorship. So when you get into the corporations or the LLC hybrid, those basically set a boundary around your personal assets and make sure that those are kept separate. And you're allowed then to protect your personal assets by creating this whole different pot, this whole new entity that its liability is limited to what's in that pot. So if I have a house and I have 2 cars and I own the lot next to my house and I have a business that I own, there's a weighing of, I don't really want to risk what I have for my business. So I'm going to create the separate entity, and I am going to only put in that pot those things I'm willing to risk. So each of those things are judged like, do I put the name of my car in the name of the business, or do I keep that personal? Each of those sort of decisions from a liability perspective and also from a tax perspective really can be considered, and there is a right answer. It's just you have to crunch the numbers to find out what that is. So taxes, when we talk about taxes, there is a franchise tax here in the state of Texas. That franchise tax is based upon gross receipts, but there is a small business exemption, which means if you have gross receipts of less than $1,180,000 a year, you have to file the return with the state comptroller's office, but you are not going to owe any franchise tax. And it's really just like a 1-2 page return. It's not that challenging. It's due May 15th as opposed to April 15th. So you do have a month to go in, and it's basically the same information that you would have prepared for the IRS. For tax purposes, all the partnerships and the sole proprietorship, you pay all of it on your personal income tax return, and you pay it not only as personal income, but you're going to pay self-employment tax on it. Self-employment tax means that you're going to be paying the 13+% for Social Security and Medicare. That's again, why people go and bother with the formalities is so that they can minimize these requirements. Sole proprietorships, general partners that are just natural people, can't be other corporations. They do not have to file that franchise tax return. They just file an individual return, report their income, and pay your regular income tax, but you will pay full self-employment tax. when you do corporations and when you do an LLC where you've elected to be taxed as a corporation, then your business will pay all of its expenses. It will file a return that will say, you know, this is each person's share in it, but you do not pay self-employment. So you save self-employment taxes as well as any sort of liability protections. You've got this tax benefit from being able to meet those formalities. You've got that option. That has a right answer. Just like I said, it's a black and white answer. So you can go in and think, put the time in to really consider up front, you know, what am I expecting to invest? What am I expecting to be the return? And if you can come up with a reasonable 3-year estimate on what your goals are, that can be taken to an accountant, and that professional can tell you this is how much money you would save or not if you had an LLC or a corporate tax structure. It's worth it. A lot of times people will, you know, easily save those startup costs within 1 or 2 years. But it has an answer, so you want to look at it. And when we talk about liability exposure, I'm sorry, I'm taking a step back. I hope that doesn't confuse you. But when we talk about liability exposure, that varies as well. And that's why you really want to talk it over with an attorney if you can, just because, you know, there's very different risk in deciding what the type of work is that you're going to do. If you're going to be around children, your risk is very different than if you're going to be selling greeting cards at Market Day. And so you've got to, what your risk assessment is on liability also impacts where you weigh different factors. A lot of people go into business thinking, okay, well, this is something I just want to do for a little while and then I want to shut it down. If you're wanting to do that, sole proprietors, general partnerships and stuff, that's easy to do. But if you're really going to be changing it or giving yourself the most options, again, those formalities have certain attractiveness to it. If you're wanting to build up a business and sell it, or hoping to retire with it by selling it, having those formalities in place will allow you to do it, but protect your interest at the same time. If you want to become, hand over management, those give you different options as well. So when we talk about the 6 different things to consider, one is what's going to give you the options as far as what is your intention in the long run with this business. Might you want to merge a couple of different companies and create a new one? Those sort of things. And then finally, when we talk about winding up a business, it has to do with the practicalities of distributing whatever assets and monies are left, or if there's debts owed, who's going to have to pay what, and whether you can just walk away with fewer formalities. That option is there, although you are personally liable for those debts. You don't have to do anything other than just close the bank and stop doing it. But if you have these registered and formally created entities that are separate from yourself, you can't just walk away. Our state comptroller's office is going to be mailing things to you and eventually knocking on the door and holding you personally responsible for not taking care of those filings. There is a process that you have to go through in order to close things down. And it's not necessarily onerous if you've been taking care of the formalities all along. But if you haven't, it can be a bit messy. And so you have to remember to take care of business as those formalities need to be met in order to make it easier to close down whenever that might be. So that's a lot of information, I know, in a very short period of time, but it does set the groundwork for what we will be talking about next week and maybe some of the weeks after. If you want more information about the Texas Franchise Tax Report, that can easily be found online. You can look at the 2020 or 2021 Texas Franchise Tax Report information and instructions. It gives you some other information about if you're wanting to do retail, wholesale. Again, all of that, you still have to meet over that $1.1 million in gross receipts. The Secretary of State's website also has a fee schedule that you can look at some of those costs. If you are considering having an attorney help you with the formation process, shop, ask around, because different attorneys do different activities and charge different rates. Some do flat fees, some do hourly. Most standard hourly fees in Wimberley area are around 250 to 350 an hour. I personally do things on a flat fee. It's $1,200 for my time plus the filing fee. So that $300 and roughly $8 with the Secretary of State. But you're going to have all the consultations involved, all of the formalities met, and in the very least, you should expect from me or from anyone else that when you leave, you know what to do to maintain what you created, and have at least like that contact information so that you can ask questions when you have them. So I don't know if there are any questions. Nami, do you know if there have been any questions? I haven't noticed.
No, I don't see any questions.
Okay.
Do you want to mention the video will be uploaded to the library's YouTube channel for
Okay.
later viewing?
I didn't know that, but now I did. And so that's good. And again, next session and starting your own business will be sole proprietorships and the partnerships, getting it right so it doesn't go wrong. We will talk specifically there about actual partnership agreements, assumed name certificates, what they are, where to file them. We'll discuss what should be contained in those agreements, how the taxes are actually filed, and again, the franchise tax a little bit for those partnerships that are subject to it. So in the meantime, if you have specific questions, you can contact me either through NAMI here at the library, or my personal email address is Carrie C, that's C-A-R-R-I-E-C 1970 at gmail.com. You can send me a general question if you have it. I am not going to be giving specific legal advice, but I am happy to point you in the direction you need to go, unless it is that you particularly want to retain my services. But this is information that, like I said, just shop and find out what your options are, or pay attention and show up next time and help you go from there. Thank you, everybody.